They told you it was a bubble. They told you it was speculation. They told you to take profits and rotate back into real assets, as if a 5,000-year-old monetary metal isn't real enough. They told you that $50 was the top. Then they told you $60 was the top. Then they told you $70 was definitely the top, and anyone still holding was a fool riding a generational bubble into oblivion. Well, look at the screen right now. Look at that number. 79.30. We are sitting at prices that the world has never seen in the entire history of human civilization. We are watching the reset happen in real time. And while the mainstream financial media scrambles to explain away the move, while the talking heads on CNBC warn you about volatility and profit-taking and the dangers of momentum, something far more important just happened on the other side of the world. Something that confirms everything we have been saying, something that proves beyond any shadow of doubt that the physical silver market is about to break wide open. Ladies and gentlemen, Asian guy here. And today, I need to walk you through the single most important policy development in the silver market since China started accumulating strategic reserves. Because while you were enjoying your holiday weekend, while the New York Stock Exchange sat dark and silent, the Chinese Ministry of Commerce quietly published document number 68 of 2025. And what is contained in that document is nothing less than a declaration of war on the Western paper silver market. Let me read you the headline from Reuters. Silver pushes into uncharted territory as precious metals broadly hit records. Uncharted territory. Those are the exact words. The financial establishment is admitting that they have no map for where we are going. They have no historical precedent. They have no playbook. And the reason they have no playbook is because this is not a normal rally. This is not speculation. This is a strategic repositioning of global capital away from paper promises and into hard assets. And China just made sure that repositioning is about to accelerate dramatically. The Ministry of Commerce announcement lays out the framework for managing state trading exports of silver for the 2026 to 2027 period. Now, I need you to understand what state trading means in the Chinese context. This is not free market capitalism. This is not companies deciding on their own whether to export silver based on price signals. This is the Chinese government telling every single silver producer in the country that if you want to export even 1 ounce of this metal, you need to apply for qualification. You need to meet thresholds. You need to prove compliance. You need to get permission from Beijing. They have set an annual output threshold of 80 tons for newly applying silver producers. For Western regions, that threshold is lower, but the principle is the same. The state controls the flow. The state decides who gets to sell silver to the outside world and who doesn't. And the state has decided that silver is too strategically important to let the free market determine its destination. Do you understand what this means? China is the world's 3rd largest silver producer. They mine millions of ounces every year. And they have just announced that for the next 2 years, every single ounce of that production will be subject to government approval before it can leave the country. This is not a tariff. This is not a tax. This is a choke point. It is a valve that Beijing can tighten or loosen depending on their strategic objectives. And given what we know about China's appetite for silver, given what we know about their solar panel manufacturing, their electric vehicle production, their semiconductor ambitions, do you really think they are going to be loosening that valve? Do you really think they are going to be sending their strategic silver reserves to the West so that JP Morgan can use it to settle futures contracts? The timing of this announcement is not coincidental. It never is with Beijing. They published this document during the Western holiday period when liquidity is at its lowest, when the traders are away from their desks, when the mainstream media is running skeleton crews and nobody is paying attention. They wanted this to slip under the radar. They wanted the market to wake up on Monday morning and suddenly realize that the supply situation just got dramatically worse while everyone was eating leftover turkey. But we are paying attention. We are always paying attention. And what we are seeing is the systematic tightening of global silver supply at the exact moment when demand is exploding. The Guardian published a piece this week highlighting the surge in silver prices and the rising anxiety about industrial supply chains. They quoted Elon Musk himself, warning on social media that this is not good, that silver is needed in many industrial processes. When the richest man in the world, a man who runs multiple companies that consume silver in massive quantities, is publicly expressing concern about supply, you need to listen. Tesla needs silver for every vehicle they produce. SpaceX needs silver for electronics and solar arrays. The Musk empire runs on silver. And he is telling you publicly that the situation is not good. Now, I want you to think about what happens when the world's largest electric vehicle market, China, decides to restrict silver exports at the same time that every Western automaker is trying to ramp up EV production. I want you to think about what happens when the country that manufactures 80% of the world's solar panels decides that their domestic silver needs come before their export obligations. I want you to think about the supply chain managers at every major technology company in America right now, the people responsible for securing components for data centers and AI infrastructure and semiconductor fabs. They are looking at this Ministry of Commerce announcement and they are panicking because they know that the silver they were counting on from Chinese suppliers might not be available at any price. This is the industrial panic we warned you about. This is the moment when the paper market and the physical market diverge so dramatically that the entire pricing mechanism breaks down, and the numbers coming out of the market are confirming this divergence in real time. Reuters reported that spot silver jumped sharply and notched a massive year-to-date gain, outperforming gold by a wide margin in 2025. Read that again. Silver is outperforming gold. The monetary metal is outperforming the ultimate safe haven. That tells you everything you need to know about the nature of this move. This is not just a flight to safety. This is a flight to industrial necessity. This is the market recognizing that you cannot run a modern economy without silver and that there is simply not enough of it to go around. Let me give you the current positioning. Spot silver is trading around $79.30 per ounce. The bid-ask spread is tight, roughly $79.27 to $79.39 according to Kitco. This tells you that despite the massive move, there is still liquidity in the market. Still two-way flow, but that liquidity is concentrated in the paper market. The physical market is a different story entirely. Reuters reported that there are 27,187 tons of silver in London vaults as of end of November. That sounds like a lot until you do the math. 27,187 tons is roughly 874 million ounces. The iShares Silver Trust alone, SLV, holds about 529 million ounces. That is over 60% of the London Vault inventory tied up in a single ETF. Add in the other ETFs, the industrial reserves, the allocated accounts, and suddenly that 874 million ounces starts to look very thin indeed. And here's the part that should terrify the banks. Here's the part that explains why Beijing chose this exact moment to tighten export controls. The CME Group futures contracts are still standing for delivery. The longs are not rolling over, they are demanding the physical metal. And with Chinese exports now subject to state approval, one of the major sources of supply to the Western market just became unreliable. The authorized participants who manage the flow of metal into and out of the ETFs, the banks who make markets and futures, they are now operating in an environment where they cannot count on Chinese silver to bail them out of their short positions. They are trapped between rising demand and contracting supply with no escape valve. Peter Grant, vice president and senior metals strategist at Zaner Metals, was quoted by Reuters pointing to $80 as a plausible near-term objective. $80. We are less than $1 away. And that target was given before the full implications of the Chinese export rules had been digested by the market. When the futures market reopens Sunday evening on CME Globex, when the algorithms start processing the news from Beijing, when the supply chain managers start placing orders to secure their 2026 allocations, do you really think we are going to stop at $80? Do you really think the round number is going to provide resistance when the fundamental story just got exponentially more bullish? Let me talk about what happens next, because the mechanics of this market are about to create one of the most violent moves in commodity history. Right now, the US stock market is closed. The NYSE is dark. The NASDAQ is silent. SLV is not trading. The mining stocks are frozen, but silver itself does not sleep. The CME Globex futures resume trading Sunday evening. That means price discovery is happening right now, in real time, based on the news flow from China and the positioning of global traders. And when the US stock market opens Monday morning, everyone who holds SLV, everyone who holds mining stocks, everyone who has exposure to silver through their brokerage account is going to see a price that reflects whatever happened overnight. This is called gap risk. And in a market this stretched, with momentum this powerful, the gaps can be enormous. If silver runs to $82 on Globex overnight, SLV is going to open at a price that is 3 or 4% higher than where it closed on Friday. If silver runs to $85, we are talking about gaps of 7 or 8%. The people who are trying to buy on Monday morning are going to be chasing prices that are already screaming higher. The people who are short are going to be scrambling to cover at prices that are dramatically worse than they expected. This is how squeezes accelerate. This is how orderly markets become disorderly. And this is exactly what the technical setup is suggesting. FX Leaders published analysis this weekend showing that silver closed the week near $79.30, framing the move as a breakout and pointing to upside targets in the $81 to $82 area. But here is the critical data point. The RSI, the relative strength index, is near the high 80s. In a normal market, an RSI above 70 is considered overbought. An RSI above 80 is considered extremely overbought. An RSI in the high 80s is historically rare. It suggests that the momentum is so powerful that normal mean reversion is not applying. The market is not respecting traditional technical boundaries because the fundamental story is overriding technical signals. Daily Forex described silver's rise as wild and meteoric. They said the price action remains strongly bullish, but warned that silver is behaving more like a high volatility momentum asset than a traditional precious metal. Read between the lines. The analysts are telling you that the old rules do not apply. They're telling you that silver has decoupled from its historical trading patterns and is now moving on pure supply-demand dynamics and momentum psychology. They are telling you that this is uncharted territory. But here is what they are not telling you. Here's what the mainstream financial media refuses to acknowledge. The momentum is not random. The momentum is not speculation. The momentum is the market correctly pricing in a supply crisis that has been building for years and is now reaching its terminal phase. The momentum is smart money recognizing that China has just signaled they are going to prioritize domestic consumption over exports. The momentum is industrial buyers panicking and placing orders at any price. The momentum is short sellers capitulating and covering positions before they get wiped out. The momentum is the paper market surrendering to physical reality. Let me explain the bubble narrative because you are going to hear a lot about it in the coming days. Tony Sycamore, market analyst at IG, was quoted in The Guardian describing a generational bubble dynamic as capital pours into precious metals. The word bubble is designed to scare you. It is designed to make you think of tulips and dot-com stocks and housing in 2008. It is designed to trigger your loss aversion and make you sell your position before the big crash. But let me ask you something. Was there a bubble in oil in 1973 when the Arab embargo created a supply shock? Was there a bubble in palladium when automotive demand exceeded mining supply? Was there a bubble in uranium when the nuclear renaissance began and utilities scrambled to secure fuel? These were not bubbles. These were repricing events. These were the market adjusting to a new supply-demand reality. And that is exactly what is happening in silver right now. The difference between a bubble and a repricing event is simple. A bubble is driven by speculation divorced from fundamentals. A repricing event is driven by fundamentals that the market previously underestimated. Look at the silver fundamentals. Global mine production has been flat or declining for years. Industrial demand is exploding due to solar panels, electric vehicles, 5G infrastructure, and data centers. Investment demand is surging as central banks debase their currencies. Recycling cannot keep pace with consumption. Above-ground inventories are being depleted. And now China, one of the largest producers, is restricting exports. These are not the conditions of a bubble. These are the conditions of a supply crisis. And the price is simply doing what prices do in a supply crisis. It is rising until demand is rationed. Rona O'Connell, head of market analysis at StoneX, warned in a Reuters analysis that the rally has been heavily investment-driven, and that upside can extend, but reversals can also be steep. She is right about the mechanics. In a momentum-driven market, when the flow reverses, the moves can be violent. But she is missing the bigger picture. The investment flow is not random speculation. The investment flow is capital seeking safety from currency debasement. The investment flow is institutions recognizing that their paper assets are losing purchasing power against real things. The investment flow is smart money front-running the supply crisis that is now becoming undeniable. When the fundamental story is this strong, the investment flow does not reverse. It accelerates. Nitesh Shah, commodities strategist at WisdomTree, described the setup as supportive given demand and inventory dynamics. Supportive is a polite word. The correct word is explosive. We are sitting on a powder keg of suppressed demand and constrained supply, and China just lit the fuse. The only question now is how high the explosion goes. Let me talk about U.S. policy risk because this is the other shoe that is about to drop. Reuters reported earlier this year that the U.S. critical minerals list was expanding under a Section 232 investigation into critical minerals import dependency. Silver was explicitly mentioned among the metals under consideration. The U.S. government is waking up to the reality that we import massive quantities of strategic metals from countries that may not always be friendly to our interests. They are considering tariffs. They are considering restrictions. They are considering policies that would further tighten the global supply of silver at exactly the wrong moment. City analysts warned that markets may be underpricing certain tariff risks. For silver, tariff risk matters because it affects where inventories are stored, which region sets the marginal price, and how quickly physical supply can respond to price spikes. If the US slaps tariffs on silver imports, the metal that is currently in London and Singapore and Hong Kong is going to become more expensive for American buyers. The ETFs are going to face higher costs for sourcing metal. The industrial consumers are going to pay more for every ounce they need. This is how trade wars work. And in a market where supply is already tight, trade friction is gasoline on a fire. Think about the position of an American solar panel manufacturer right now. They need silver for their panels. China is restricting exports. Mexico, the largest silver producer in the world, is politically unstable. The US might impose tariffs that make imported silver more expensive. Where are they going to get their metal? They are going to have to compete with every other industrial consumer in the world for a shrinking pool of available supply. They are going to have to pay whatever price the market demands. And the market is demanding $79.30 today and will demand $85 next week and $100 the week after. Now let me address the people who are watching this video and have not yet bought silver. I know you are out there. I know you have been watching from the sidelines, waiting for a pullback, waiting for the right entry point. I know you have been telling yourself that it is too late, that you missed the move, that buying at $79 is chasing. Let me be very clear with you. The risk is not that you pay too much. The risk is that you cannot buy at all. We are entering what I call the unobtainable phase. This is the stage of a supply crisis where price becomes secondary to availability. The wholesalers run out of stock. The dealers stop taking orders. The mints go on allocation. The buy button disappears. We have seen it before with ammunition. We have seen it with computer chips. We have seen it with baby formula. When the supply chain breaks, price is irrelevant because there is nothing to buy. Reuters reported that the major physical market is London OTC, supported by bullion held in large bank vaults. But those vaults are not infinite. The 27,187 tons of silver in London is not sitting there waiting for retail buyers. It is allocated. It is committed. It is backing ETFs and industrial contracts and bank obligations. When the longs stand for delivery, when the industrial buyers scramble to secure supply, when China stops exporting and the US imposes tariffs, that metal is going to evaporate. And the retail investor who waited for a pullback is going to find that the pullback never came, and now the metal is gone. This is why I've been telling you for months to buy physical, not SLV, not mining stocks. Physical metal in your possession. Because when the system breaks, when the paper price and the physical price diverge, when the authorized participants cannot source metal to back the ETF shares, your paper claim is worthless. But your physical metal is real. It is in your hands. It cannot be diluted. It cannot be defaulted. It cannot be restricted by a Ministry of Commerce document from Beijing. It is yours. Let me walk you through the Monday morning playbook because the next 48 hours are going to be critical. Tonight, Sunday evening, CME Globex silver futures reopen. This is when the market digests the China news. This is when the algorithms start running. This is when the price discovery happens. If you're trading futures, you need to be watching the Globex session closely. Expect volatility, expect gaps, expect moves that would be considered extreme in any normal market. Monday morning, the US stock market opens. SLV and the silver miners will start trading at prices that reflect whatever happened overnight. If silver ran to $82 on Globex, SLV is going to open dramatically higher than Friday's close. The retail traders who set limit orders over the weekend are going to get filled at prices they did not expect. The short sellers are going to face margin calls. The momentum is going to compound. Throughout the week, watch the macroeconomic data and the Fed commentary. The rally has been turbocharged by expectations for Federal Reserve easing in 2026 and a softer dollar. If the Fed signals that rate cuts are coming, the dollar will weaken further and silver will benefit. If inflation data comes in hot, the real value of cash deteriorates and silver becomes more attractive. The macro setup is supportive from every angle. Also, watch the physical market. Monitor the premiums that dealers are charging over spot. If you see premiums expanding, if you see delivery times stretching, if you see products going out of stock, that is the signal that the paper price is diverging from physical reality. That is the signal that the squeeze is intensifying. That is the signal that you need to act immediately. Now I want to address the people who are already holding silver, the stackers, the long-term investors, the believers who have been accumulating for years. You were right. I said it before and I will say it again. You were right. Every time someone laughed at you for buying a pet rock, every time someone told you that silver was a relic, every time someone questioned why you were hoarding shiny metal instead of investing in real assets, you were right and they were wrong. The price is now proving what you always knew. Silver is money. Silver is essential. Silver is irreplaceable. But I need to give you a warning. The volatility is going to be extreme. We are going to see days where silver drops 5. We are going to see shakeouts designed to break your conviction. We are going to see the mainstream media running headlines about the bubble bursting and the top being in and the smart money exiting. Do not believe them. Do not let them take your position from you. The fundamentals have not changed. China is still restricting exports. Industrial demand is still exploding. Investment demand is still surging. The supply crisis is still deepening. A $5 pullback is not a trend reversal. It is a buying opportunity. Peter Grant from Zaner Metals warned that year-end profit-taking remains a risk even as the broader trend has stayed powerful. He is right that some traders will take profits. It is natural. It is healthy. It shakes out the weak hands and reloads the spring for the next leg higher. But the investors who understand the fundamental story, the investors who have done the work, the investors who know why they own silver, they are not going to be shaken out by a 5 or 10% pullback. They are going to add to their positions. The $80 level is the immediate target. We are less than $1 away. When that level breaks, and it will break, the next psychological target is $100. From $80 to $100 is a 25% move. In a normal market, that would take months or years. In this market, with this momentum, with these fundamentals, with China restricting exports and the Fed preparing to ease and industrial demand exploding, it could happen in weeks. The trajectory is not linear. It is exponential. And the exponential phase is where the real wealth is created. I want you to think about what $100 silver means for the world. It means that the solar industry's economics change dramatically. It means that every electric vehicle becomes more expensive. It means that data centers and AI infrastructure face higher costs. It means that the green transition becomes more expensive at exactly the moment when governments are trying to accelerate it. It means that the industrial economy has to adapt to a new reality where a critical input has repriced higher by 200% in 2 years. And it means that you, the investor who saw this coming, the stacker who accumulated when everyone laughed, the believer who held through the manipulation and the smashes and the endless propaganda, you are sitting on life-changing gains. This is the wealth transfer we talked about. This is the moment when capital flows from those who hold paper promises to those who hold real assets. This is the vindication. But the wealth transfer is not complete. We are in the early innings. Silver at $79 is still cheap relative to the money printing that has occurred, relative to the industrial demand that is coming, relative to the supply constraints that are tightening. The historical gold to silver ratio averaged 15 to 1 for most of human history. Today, it sits closer to 80 to 1. Even if gold stays flat, a reversion to the mean implies silver prices multiples higher than where we are today. And gold is not staying flat. Gold is hitting all-time highs alongside silver. The entire precious metals complex is being repriced. So here is your action plan. If you do not own silver, buy it now. Do not wait for a pullback. Do not wait for confirmation. Do not wait for the mainstream media to tell you it is safe. By the time they tell you it is safe, the move will be over. The time to act is now, while the metal is still available, while the premiums are still manageable, while the system is still functioning. If you own silver in ETF form, consider converting to physical. SLV and SIVR are fine for trading the paper price, but they carry counterparty risk. If the authorized participants cannot source metal, if the NAV diverges from the underlying, if the system seizes up, your paper claim may not be worth what you think it is. Physical metal in your possession has no counterparty. It is pure wealth, unencumbered by the obligations of a failing financial system. If you own physical silver, hold it. Do not sell into the strength. Do not let them shake you out. The pullbacks are coming, but they are not trend reversals. They are opportunities to add. The fundamentals are only getting stronger. China is restricting. The Fed is easing. Industry is panicking. Supply is evaporating. Every factor is bullish. And if you are already fully positioned, spread the word. Send this video to everyone you know. Help them understand what is happening. The silver story is not complicated. There is not enough metal to meet demand, and the price has to rise until demand is rationed. Every person who understands this story and acts on it is another soldier in the battle against the paper manipulators, another pair of hands holding metal out of the vaults, another unit of demand that cannot be met by supply. The Ministry of Commerce document from Beijing is the latest confirmation that the supply situation is tightening. But it is not the last. More restrictions are coming, more tariffs are coming, more industrial panic is coming. The Western paper market has been living on borrowed time, borrowing metal from ETFs, borrowing metal from central banks, borrowing metal from the future. And the future has arrived. The bill is coming due. The metal is being demanded for delivery. And there's not enough to go around. Silver at $79.30 is not a bubble. It is not speculation. It is not a generational top. It is the beginning of a repricing event that will take this metal to triple digits and beyond. The mainstream media wants you to be afraid. They want you to sell your position and miss the move. They want you to stay in paper assets that they can control and dilute and manipulate. Do not give them what they want. Hold your metal. Buy more metal. Understand that you are on the right side of the greatest trade in a generation. The futures market reopens tonight. The stock market reopens tomorrow. The volatility is coming. The gaps are coming. The wealth transfer is accelerating, and you are either positioned for it or you are not. There are no second chances in a supply crisis. There is no waiting for confirmation when the metal runs out. The time is now. The price is $79.30. And the next stop is $80, then $85, then $100, then levels that the world has never seen. I am Asian guy. The silver squeeze is real. China just made it worse. And the only thing you need to do is hold the line while the system breaks around you. Like, subscribe and share this video. I will see you on the other side.